Hey miners, welcome back to the channel McNallie Money, the new home of power mining analysis. In today's episode, Anthony Power and I are pleased to welcome Patrick Fleury to the channel for his first visit. Patrick is the CFO of TeraWulf. They just came out with their Q2 earnings, which we're going to be discussing and analyzing in today's presentation. Before we do though, please take a second, smash the like button for us. It's a big help to the channel, helps get this content to other people like you who may find value. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comments section below if you're currently holding shares of TeraWulf, what you thought about their Q2 numbers, and your outlook for the back half of 2024. Now with that being said, let's get into today's interview. Okay guys, so that's right. Today's video, we've got the CFO of TeraWulf, Patrick Fleury, on the channel, hot off the heels of their Q2 earnings. We're going to be talking numbers and strategy in today's podcast. But before we do, Patrick, this is your first time on the Power Mining Analysis platform. So welcome and thanks so much for taking the time out of your day to discuss with us.
Thanks for having me. Love what you guys do and pleasure to be on the show.
Hey, you're most welcome. So we'll get right into it. We figured because it's your first time on the program, can you give us just a quick intro on yourself, how you got into the Bitcoin mining space, specifically TeraWulf?
Yeah, sure. I'm boring, so I'll make this short and sweet. But I've been in finance for 25 years, started my career right out of college in 2000 as a banker. Started in the energy and power group at B of A, which was one of the least desirable groups, but have been around energy and power my whole life. And so early 2000s actually was an exciting time for power, probably the last time over the last 25 years where it was actually exciting. And a lot of the big power companies over-levered, built too much capacity, ultimately had to restructure. So I went from being a banker helping finance that to then a banker helping restructure all of it. And that was really sort of my trial by fire in the power space. And then joined up in 2006 with three gentlemen that ran George Soros's firm from 87 to 99. And they left in 99, started a firm called Satellite Asset Management, which was one of the first big hedge funds in the world. Similarly, they ran that Soros with Stan Druckenmiller, who I'm proud to say is an alumni of Bowdoin College, where I went. And so I'm very blessed that I get to see Stan speak a lot. But he also left in 99, started Duquesne. These three gentlemen started Satellite. I worked with them until 2011. The fund grew to about 8.5 billion. Also very big focus on distressed power. So all the different sort of assets that came out of the power business, we ended up buying the debt of and restructuring and then selling those ultimately back into power companies like NextEra and Vistra and others. And so left them in 2011, went to Blackstone for about 7 years, which is where I met I had known Paul and Kerry and Stephanie and the whole TeraWulf management team for about 5 years prior to that. So literally we met, I think, in 2006. And at Blackstone, we put together a strategy to go buy distressed power assets all over the US. And Paul and Nazar and Kerry and Stephanie were my management team. And so we have all known each other for, geez, at this point, almost 20 years, 18 years or so. And when I left Blackstone, they went to Blackstone. The assets were sitting in a fund that was winding down. They effectively did an MBO and bought the assets back personally. And that formed the basis for them, frankly, putting Marathon Digital in business originally at the Hardin plant in Montana. They did that, figured out, wow, we can do this, better, and we can do it in a very ESG friendly way. And that led to the creation of TeraWulf. So that's kind of my background. I was brought in as CFO in May of 2022. The company had gone public at 60,000 Bitcoin. Bitcoin went straight down to 20. We had a bunch of debt. So thankfully for me, the debt was held by 5 or 6 folks that I've been investing with for almost 20 years on the buy side. And, we amended that debt 5 times, got a financing done and basically, saved the company. And now, we're in this amazing position where we're debt free. We're generating a lot of free cash flow in our mining business, and we're sort of diversifying into high power compute and AI, and it's super exciting time. It's a little bit odd for me not to be focused on, distressed rescue and now focused on how do we create billions and billions of dollars of value for us and our shareholders, but super exciting. So sorry, went a little bit long there, but I just want folks, I think it's unique background as to like why I'm in this seat and my relationship with this management team.
Just
Well,
a quick one, Patrick, before we get into questions. That George Soros rings a bell. I think he tried to take down the British economy, didn't he, at one point?
Stan Druckenmiller, yes. Yeah,
I
that's a
thought you
great
might have a
story.
comment on that one, Anthony. I was
That's a
going to
fine
say
other day.
rubbing shoulders with some big names, and I wanted you to go into detail, Patrick, because I know the TeraWulf team is very tight knit, a lot of long-standing relationships, and it's so interesting. This intricate distressed power background brings you into Bitcoin, and now Bitcoin is ultra focused on these distressed power assets as you guys move into HPC and other applications. So very interesting, very relevant background, and we appreciate you sharing that. Now, you mentioned exciting times for TeraWulf, positive cash flow, growth on the horizon. I want to get into that here. If you can share a few of your Q2 earnings highlights, then Anthony can break those down a little bit more, but generally expected to be a fairly difficult quarter for the mining industry, and TeraWulf really has some strong numbers to show there.
Yeah, look, I mean, the key to this business, and I just hit on it, is power, right? I mean, power cost is everything. And the difference is, if you have we used to have the saying at Blackstone, bad balance sheet, bad business, not fixable. Bad balance sheet, good business, fixable, right? I mean, that's a common saying in credit and distressed. And so when I look at this space, right, for a long time, as you guys know, we had debt, but we were confident in our ability to eliminate that debt and fix the balance sheet because our underlying business fundamentals were so strong. And you look at this space and you can't fix bad power. You either have good power because your sites are in places where there's an abundance of excess power, or you're in locations where power prices are high. And as a Bitcoin miner, right, and I think let's separate the HPC AI discussion. As a Bitcoin miner, your profitability, it doesn't matter if you're 5 exahash, 10 exahash, 50 exahash, okay? Some of my peers are growing to 30 or 40 or 50 exahash. That growth is garbage, in my opinion. It doesn't matter if you don't make any money on your mining business. So again, you make money or lose money in this business based on your power cost. Like this concept that growing to 30 or 40 or 50 exahash helps you amortize SG&A. Yeah, maybe if you pay your executives like NBA players, right, then yeah, it's going to help you amortize that huge fat SG&A. But if you're not making any money mining business, it doesn't matter what you grow to. So again, like you either have good power or you don't. We have good power. I've seen Cypher's results. Cypher's got good power. Like there's a few of us that actually put out disclosures that show you, what our actual realized power costs are. So that's the name of the game in Bitcoin mining. I'm super proud of our team, our results. I mean, as you point out, Bryce, really challenging quarter with the Bitcoin halving, cutting the rewards in half. We still put up about 20 million of EBITDA. We put up a 61% gross profit margin. If you take the impact of Nautilus, which is not in our GAAP financials, and adjust for that, I think we got closer to 65% gross profit margin. So yeah, just a kick butt quarter for us, and took advantage of that free cash flow, continued to pay down debt. And then I would add too, I think a little bit I've heard from folks, they were a little bit upset with our level of dilution. And I would just say, I understand. I'm a big shareholder of the company too. I don't want dilution, but sometimes right, dilution is necessary. And in this case, it was for good purpose. We used it to repay all of the remaining debt, which, by the way, we had a maturity later this year. And that really, when I look at it, was the only thing that really capped the option value for our future equity, right? I mean, a hard maturity in December, right, which is only a few months away, was a big concern of mine, particularly if the market took a step down in Bitcoin, which we've seen over the past couple of weeks. And so we really took advantage of that liquidity of the market move to, issue dilution, use it to pay down debt. And then we also are using it, if you look at our slide deck, to basically slingshot us into high power compute and AI. So now, I mean, we are in my opinion, pole position, and I'm trying to create $5-10 billion of value in high power compute and AI. And I had debt holders that were really restricting my ability to do that because they had security over everything. So for me, again, I don't like to use dilution. You guys have heard me say that before. And, our management team, I think now, I got to look, but I'm guessing we're like total insider board management team, probably 20 to 30% of the equity that we own. So we are very focused on it, very protective of dilution, but at certain times, we think it's useful. And so now where I am is if I can get the financial engineering correct on high power compute and AI, I need zero additional equity, and I've got a free cash flow positive Bitcoin mining business. So now I'm in the luxurious position of, I'm now in a sort of capital allocation problem of, I got to go to my board and figure out, do I pay a dividend? Do I buy back stock? Like, do I pay a dividend in Bitcoin? Do I pay it in cash? And that is where I'm trying to go and get this company. And I don't think that could stand in starker contrast to most of my public peers. I mean, that is like just completely opposite of this growth at all costs, get to be this massive empire and dilute shareholders to stack Bitcoin on your balance sheet. And look, I get that. I love Bitcoin. Don't get me wrong. I love it. I own it personally, but I would rather own the ETF to play Bitcoin longer term than a lot of the public Bitcoin mining peers that have proven they don't make money at today's pricing. TeraWulf is different. We mined Bitcoin in the second quarter at about 41,000. We're going to mine it in the second half of this year at about 40,000. It's on the screens at 60, and I'm mining roughly 7 Bitcoin a day. So you can do the quick math. Like, I am making free cash flow, and I am free cash flow positive every single day. And that to me is the difference in the business model. And yes, I sell it all today because I'm trying to fund growth in both Bitcoin mining and in high power compute and AI. But there may come a time where, we change that philosophy. I can tell you it's not now, but if we can get the financial engineering correct on the high power compute and AI diversification, then the world kind of becomes our oyster from a, what do we do with our Bitcoin? What do we do with our cash? But, and I'm not far, I kind of think that's a sort of 3 to 6 to 12 month kind of thing that's going to unfold for TeraWulf.
Yeah, some good points there, and rightly so. The power is obviously key. I think another parts of that is probably the efficiency of the mining machines as well. That will play a part in making sure you're equally getting the whole cost of mining down. For those people that don't understand, you have got a sort of the JV at the Nautilus site there, and you've already articulated that you can't include all that information in your GAAP accounts. Can you sort of like explain some of those challenges that you're facing and how, I think you use the adjusted EBITDA as a way of sort of showing or presenting what that final position looks like?
Yeah, look, and I think you'll see in our updated investor deck, I had heard from a lot of both retail and institutional investors, their frustration with that, Anthony. So we added a new page to our investor deck this quarter. It's page 10. It walks through exactly sort of how the accounting works with the Nautilus JV. And again, this is not my choice. It's GAAP accounting rules. So believe me, if I could consolidate it, I would. but I can't, and that's unfortunately just how the game works. So I've really tried to go the extra distance here and lay it out for everybody on page 10 so they can see it. I walked folks through it on our conference call last night. So I'm really, again, and I think you guys know this, like I have really tried to commit TeraWulf over the past couple of years, and maybe to a fault versus some of our peers, to complete transparency and accountability with regard to our financials. I mean, you look at our deck, no one gives you the level of financial disclosure, particularly on page 14, where I show you every single cost in the company, right? I mean, and not only that, but I'm telling you like what I think my annual SG&A is, what I think my annual power cost is, what my annual site level operating expenses are. And so, yeah, I think, we run a really tight, efficient ship. That's Paul's Navy background kind of coming through there on us all. But I mean, I'll give you an example, by the way, to that point, Anthony. And, and there's a little bit of operating at a nuke versus operating, in upstate New York in this. But for example, my operating costs for the year are projected at 13.5 million. That is split 50% Nautilus, 50% Lake Mariner. So just think about that for a moment. I am running 50 megawatts at Nautilus. I am running 200 at Lake Mariner. So I'm being billed 6.75 million roughly, right, for 50 megawatts for a year, versus I am running 200 megawatts for 6.75 million. So again, that's how efficient, I think Talon does a good job of running their site, and a little bit there is the cost of running behind the meter at a nuke. But I also think like we do an amazing job of operating those sites on a super efficient basis.
Sorry, so I mean, obviously the Nautilus site, the energy is a really cheap cost, but you're saying the other operating costs can be quite significant there.
Correct. I mean, I'm not like they do a good job running that site, but I'm just putting into context for you, like, 6.75 million for 50 megawatts versus 6.75 million for 200 in operating costs. Right now, to your point, power is different. 2 cents at Nautilus, closer to kind of, generally speaking, 3.84 cents at Lake Mariner. So yeah, I mean, it's still, don't get me wrong, like, I mean, I was looking the other day, we're probably mining Bitcoin at Nautilus right around 19,000, 20. I mean, I don't think there's a more efficient site in all of the US, right? So it's an amazing site, but I just am trying to put a little bit of emphasis on, like, we run a really efficient operation at Lake Mariner.
So just to take the energy stage further. So I saw in your last update, you talked about energy credits. And so are the credits for the Nautilus site or for Mariner site?
No, Nautilus, again, is fixed cost of power. No, we're not connected to the grid.
You're getting the credits for Lake Mariner then, yeah?
So the demand response programs that we're involved in New York, yes, those, and again, it's a little peculiar because I know other miners do this a little bit differently, right?
In Texas, yeah.
Yeah, exactly. But what we do, again, we participate in demand response. So the grid operator will call us usually day ahead and say, we need you to kind of switch off between 3 and 7 p.m., for example. And then, we get paid consideration to do that. And so that, again, the demand response numbers are not in our monthly operating reports when we tell you the realized price of power. We do include those numbers, though, when we file our 10Q and 10K. So they are in our SEC filed financials. So that's just a little bit different than what I think I've seen some other public companies do.
Yeah, it depends where I mean, right included below the line. They have a line there that just says the energy credits or power sales or whatever. And so they'll deduct that from their energy cost to come out with a sort of like a mining margin that incorporates what they paid, what they're expected to receive back from their revenue to get their margin. Yeah.
And we do, like, if you look in our MD&A of our 10Q, you'll see a table in there that shows our
Yeah,
marginal cost to
they are
mine.
future credits, but I mean, in all sense and purposes, you're going to get the credit back. It's just that you're accounting for it. In terms of non-GAAP accounting, you're showing the mining margin. You've curtailed that period. You're going to get rewarded for it.
Correct.
Therefore, yes, it comes off your future. I mean, it comes off your future energy bill. It'll be a reduction on your future energy bill.
Yeah, I mean,
Effect.
in GAAP accounting, we accrue for it in the
Yeah,
period that it's realized. So in
yeah.
our MD&A section, you'll see
You account for it as and when you yeah yeah, and I think the rest of the miners are doing that as well in terms of they want to highlight. I mean, you guys want to highlight the margin that you got for that period. So um, that's good. And adjusted EBITDA as close to the free cash flow amount as well for the companies. You'd say there's not too much to differ from that there. I mean, is there any? I mean, I don't know if I look at like cash flow from business operations as a way of is that because again it's GAAP? Is that wouldn't be the right number to use in there either, would it? I suppose.
I don't think so. I mean, I'll tell you just from both my sort of buy
Yeah,
side experience over kind of 18 years, and then the way I look at personally at
yeah,
TeraWulf. Yeah, I mean, our adjusted EBITDA, which includes the actual distributions
yeah,
from Nautilus, right? That less our interest expense, which is now going to be sort of zero moving forward. That's really
yeah.
that's our free cash flow because we're not a taxpayer. So that's how I look at it.
Yeah, no, I just wanted to clarify that. That's really good. And you've already clarified the ownership question we've got there for the senior team, probably close to the 30%, which I suppose is a good position to be in. I mean, we've obviously seen the market at the moment. We've seen the riots and the Bitfarms ordeal going at the moment, and the senior shareholders in Bitfarms have got literally nothing in the company, maybe 1 or 2% of the shares. So that's the challenge. But TeraWulf, in terms of their ownership, it's a whole different beast, and so they'd have to go through a lot more hurdles to even attempt to do what Riot are doing at Bitfarms. But actually, one thing I noticed on your balance sheet is you've got these preference shares, and it's just really a question about
Yeah.
who owns the preference shares. What voting rights do they have? Do they have any extra voting rights in
No.
terms of? I noticed some companies. I'm not saying TeraWulf, but I noticed. I think one of the big ones, Marathon, I think, have got preference shares where their voting is significantly higher than the shares.
Yeah.
So effectively, they can vote through certain things like maybe the ATM or something like that because they were just getting probably frustrated with the shareholders saying no, and they looked at another way of doing it. But when I see preference shares, I'm thinking the worst. I'm thinking, it may be nothing, but
No.
in terms of dividends, in terms of and conversion to common stock, and is there an impact on enterprise value? So there's a lot of little bits there, but I mean, you could probably just clarify that in a couple of sentences,
Yeah.
maybe.
So no, it's super simple and super benign. 10 million, total of 10 million of preferred that was put into the company, frankly, when the company was in massive distress. I think it's basically, less than 10 holders of that. And it's a 10% paid in kind quarterly, and no covenants, and it converts at a $10 stock price. So it really.
So when the stock price gets $10, those will convert across into common
So I
shares.
think mandatory conversion, above kind of $10. And so it is really teethless and just frankly, a vestige of like when the company was in distress and needed capital.
Yeah,
And so
that's fine. And from a dividend perspective, if you're not paying dividends, are those dividends sort of like accrued and then paid out when you are in profits?
yeah, so again, it's a 10% paid in kind. So it just adds on to and you can see it, I think, on page 20 of our investor deck.
Yeah.
It's the equivalent today because it's accrued, I think. So it's the equivalent today of around, 1.2 million shares. So it's really like de minimis and
Yeah. Not in
honestly,
terms of what you've got as total shares at the
yeah, and
moment.
honestly, it's going to fix itself because My view
No, I
is
don't know. I know there's, with another miner, there is an issue with preference shares, and I'm getting to the bottom of that one there now. And I saw preference shares on yours, and I went back, and it's been there for the last few years. I think
yeah.
May 2022, whenever it was. I think it was probably about the time you joined. Maybe you instigated it. I don't know.
No, that happened before that happened before I
But it
joined.
looks like it's from that just before you arrived at the company. I think there was
Yeah.
there obviously was they were put together there. But
Yeah, no,
it
and look,
sounds like it's nothing to be overly concerned about. I know in some instances it can be, because there is a clause that says they have to be bought out at a certain price, and therefore, as a minority interest, when you start talking minority interest and enterprise value, you then start adding that as debt effectively, because that's a debt to the company if they have to sort of make that issue of shares in the future at a price that seems quite high. Then it becomes an issue then in terms of enterprise value is like increased. So when you're doing a comparison, it stands out a mile. But no, thanks for the frank response, Patrick.
Hey, Patrick, I just wanted to circle back on the energy position here. We've got a few questions from subscribers, so they may kind of blend together, but you've talked about the benefits of obviously TeraWulf's energy position that you guys are in, the fact that you've got access to this really unheard of contract with the nuclear power access, the low cost power. Can you give us some details on how did you guys really get into this situation? I know there's the relationship with Beowulf. You've got contracts at each of these sites. How long are those contracts good for? Are we able to renew at these same levels? Can you give us some details? Just how did you get in this situation? And are you able to stay in this situation effectively?
Yeah, sure. So let me start with Nautilus. It's a good question. So Nautilus really came about because, and this is before I joined the company, but I had a terrific relationship with Talon's management team and private equity owners. So Riverstone owned Talon for a long, long time. There was a terrific partner at Riverstone, Carl Williams, that had been in the power space for a long time. And really, I introduced the Beowulf team in there. I also knew the CEO, Alex Hernandez, for a very long time. And candidly, at Blackstone, we also had a very big position in Talon bonds. And so obviously, I think the world of Paul and Nazar and the team, but just came with a simple introduction, and they ran from there. And really think they convinced Alex and Carl and that whole team, after sort of showing them what they had done at their facility in Montana with Marathon, that there's and really, I'm going to get a little bit geeky on you here, but Nazar, to his credit, right, he's really the thought leader in our company. And when Nazar and Paul and the team bought back the assets from Blackstone, they started thinking creatively on, okay, look, the age-old way of selling power, which is you just turn your plant on and you sell power all the time, doesn't really work anymore, because you have these intermittent resources like solar and wind coming onto the grid at odd times and basically really changing the price of power. And so his thought was let's create load sinks at our existing power plant sites that can be very responsive, so that when it's not attractive to sell power onto the grid, we can just sell it to ourselves and mine Bitcoin, for example. And then when it's very attractive to sell it onto the grid, we'll curtail the Bitcoin mining operation and sell it, right? So that was the fundamental basis, candidly, for getting into Bitcoin mining, was how do we sort of arbitrage power? And that, really has now led to the modern sort of TeraWulf, which frankly, at Susquehanna, which is the 2.5 gigawatt nuke owned by Talon, when you dig into how power works, and I can explain some of this with Lake Mariner, they are transmission constrained at that unit, meaning all the power in Pennsylvania, where they are in Western Pennsylvania, wants to flow east to the demand center, right, toward Philly, toward New Jersey, but there are transmission constraints based on the existing system. And so what that means is they can only get a certain amount of energy through the transmission constraint when there's congestion. And that, generally speaking, is around, I think for them, around like 1,900 to 2,000 megawatts. And so what Paul and Nazar and the team did was take that same concept of let's develop a sink to Talon. They had the vision, and by the way, I tip my hat to Carl Williams, to Alex Hernandez, a lot of the guys that are not with Talon anymore, right? But they had this, they had A, were brave enough, and B, had the vision 4 years ago, right, to basically say, you know what, that makes a lot of sense. We're going to set up a Bitcoin mine and we're going to build a data center of the future campus. And that's what they did, because they realized if we can sync that load on our site and then we can get more or get megawatts out that are not congested, then we'll realize a much higher power price over time. So that same concept that Nazar started out with, he convinced them to do, and now they just made a fortune selling that to Amazon, right? So that was a true vision in the space, right? I don't think you guys, like, we all can't appreciate how hard that was to do 4 years ago, but they just proved it makes a ton of sense. And now, by the way, you're seeing copycats in Constellation and NRG and Vistra and everybody, right? So that, I think, will be more the data center of the future. So not back to Nautilus, it's 2-cent power for 5 years. That term ends the first quarter of 2028. And then our lease on that site runs through 2033. So those are the facts. The other fact is Talon sold the site, which is basically the land and the substation, to Amazon for $650 million. And Amazon now has the right in the future to pull ultimately up to 900 megawatts of power at that site beyond 2033. So Amazon is now my landlord, Talon's landlord. We make our lease payments under the ground lease to Amazon. So the unique aspect of that is post 2033, there's really no terminal value there, right? Because if you're Amazon, you're like, hey, thanks for showing up. You know, I'm going to take the assets now. So that's Nautilus. If it's okay, can I now, any questions, or can I move to Lake Mariner?
No, I think that's good. My only question there is, you say the 2-cent is up in the first quarter of 2028, but you've got the lease for additional years there. Do you have any indication of the rate for those remaining years?
Yeah, that's a great question. So we have a provision in the lease that allows it to reset at market prices. Market prices are basically referencing PJM West power. So right now, that's, you know, generally speaking, probably between 4.5 cents on average. So that's likely where, call it from, you know, second quarter of 28 through 2033, you know, unless, you know, we negotiate a different price, you know, we'll see. But again, like Talon, and I'm not telling you anything that's not public, Talon's been running a public process there, right? They're trying to liquidate the entire company, not just the Bitcoin mine, right? They've been selling gas plants in Texas. They've been selling other facilities. And so the bulk of the value that Talon has resides at Susquehanna, right? It's one of the nation's most efficient nukes. And so they are looking to monetize their Bitcoin mining business. And so we have certain rights in that process. I would say most of it's just passive, but whoever kind of comes in and buys their portion, may want to buy our portion too. You know, I think we're at the right price. You know, there's a price for everything in life, right? So at the right price, we would perhaps sell. We perhaps could buy if Talon wants to buy, or, you know, Amazon's at that site too. And the quickest way to getting, you know, capacity online for them is the capacity we have. So I think that's a very dynamic process. And I would just say kind of stay tuned. And I think it'll kind of work itself out over the next, you know.
Just to take that stage further, and you mentioned about the splitting costs between Lake Mariner and Nautilus, the split of the 13.5. I'm trying to work this out in my head. Like, so if the power price increases at Nautilus to closer to, say, market rate, or even, you know, higher than market rate, why would you continue there? Unless, I mean, the question is, if you didn't have Lake Mariner and your only site was Nautilus, would that still be bringing a profit to the organization at the moment.
Yeah. I mean, look, as you point out, I mean, our realized price at Lake Mariner last year was 3.8 cents, right? So, I mean, depending on what kind of machines you're mining with, right, Anthony, as you rightfully point out, I mean, a lot of my peers are mining above 4.5 cents. I mean, I just saw
No, this isn't about others. This is just I'm just trying to get into my headspace because
yeah,
you
but
said about
again,
the split for 50 megawatts and the split for the 195 megawatts or whatever at Lake Mariner seems to be, in terms of operating costs, 50-50. So that means your operating costs for Nautilus are significantly higher than they
yeah,
are for Lake Mariner. So the energy price, yes, it's cheap energy for that bit there, but there must be a point at which it sort of becomes unprofitable, or less attractive. Maybe that's. So I'm trying to think of the right word. I don't say it's unprofitable, but less attractive to be there.
I look, what you're saying makes sense. It's as you know though, light years ahead of me in Bitcoin. I mean, we're talking about first quarter of 2028, and I mean,
I was trying to link that with the fact that I think when we questioned Paul last time, and the fact that these news stories have come out with regards to maybe Amazon, and we sort of, I think Bryce asked the question about would you ever consider selling your share at Nautilus?
yeah,
And I think Paul said if they wrote a big enough check, of course we would.
Well, it sounds like really these next 4 years are the sweet spot for Nautilus, right? And then if something presents itself at that point, that's another story. But no, I appreciate the context there, Patrick. And then for the Lake Mariner, I've got a couple follow-ups to do with the HOPA Port Authority and that situation as well. But how does that look from a power standpoint?
Yeah, look, Lake Mariner is a different beast, right? So Lake Mariner was one of the last coal plants in New York. It was retired. In return, we got a high load tariff for the first 90 megawatts from NYPA, but that's grid power, and really there's no expiration date, right? It's not like we don't have a contract for a specific price of power there. We're just taking power off the grid. And so that is more of, and I'll just go through electrically how it works. But right now we have the right to pull 250 megawatts off the grid. We've already are in the queue to pull an additional 250, and my ops team is telling me that likely comes through in the fourth quarter of this year, first quarter next year. So then that gives us the right to pull 500 megawatts, right? The site was a 700 megawatt coal plant. And so the electrical infrastructure on the site, which you would never rebuild today because it would cost you tens of millions of dollars, right, is one of our competitive advantages because it's all there. We don't have to rebuild it. We have two 345 kV connections with multiple transformers, meaning we have built-in redundancy already. We lose one transformer, we just switch to the other line, right? So you would never build that for specific Bitcoin and data center sites today because it would cost you a fortune. And so as we look forward, that site, we know once we can pull more megawatts than 500, but once we pull or intend to pull more than 500, we need to go back to New York ISO. We need to do a transmission study. And we think order of magnitude based on the transmission studies that we've done, it will be $10 to $20 million of local transmission upgrades that we'll pay for. And then we think we will be able to pull, let's say, another 250 megawatts. So as you guys know, a lot of investors will ask me, well, why aren't you doing that now? And the answer is that's not how electrical infrastructure and grids work. Once you have a bead, which we do, to 250, we went in and we now are waiting for that 250 to come again, fourth quarter, first quarter. So then we'll be authorized to pull 500, which again will help us with our expansion into high power compute and AI. Once I sign a customer up for those megawatts and I know kind of when they're going to be used, then I'll get back in line with the grid operator and say, hey, I need another kind of 250, 300. Here's the time frame. Let's do the transmission study. We'll pay for the local upgrades, right? And that's how the grid, New York ISO and frankly, grid managers anywhere manage the grid. You can't just say, I want 1,000 megawatts and not know when you're going to use it. Like it just doesn't work that way. So that's our approach there, Bryce. And again, there's no timeline to expiry, if you will. Like that's just power, that we can consume. And again, part of that is a function of location, right? So we're in a zone where there's about 5,000 megawatts of power generation. And I think on average, like 1,800 megawatts of demand, with peak demand around like 2,300, 2,500 megawatts. So it's just located in an area where there's an abundance of largely zero carbon power, right? Upstate New York is Niagara Falls and one or two nukes, Jenna and Fitzpatrick. And so there's a lot of excess power, and the power moves basically west out of Niagara Falls, east across the state on the Energy Freeway, which is a 345 kV line. Then it hits the north-south 345 kV line in New York, and that's all the hydropower coming out of Quebec. That basically all of that power tries to make its way down into the load pocket of Westchester and New York, because that's where the highest demand is. So that's how power moves in the state. And we happen to be literally 35 miles east of Niagara Falls in the first bus bar on that Energy Freeway.
Excellent highways, eh? Everybody comes from the burbs into the city centers, and I appreciate the explanation on how that portioning goes with the power structure as well. Not quite like the buffet line where you can just take whatever you're looking for. Now, Patrick, I just had one follow-up because a few weeks ago there was a lot of noise on Twitter about the Hopa Port Authority really having interest in this location. And as you talk about some of these features of Lake Mariner, obviously the infrastructure, the access to the lake, the proximity to power generation there's a lot to like about this location. Is that still a discussion that's been entertained? And if that did proceed, would you still have opportunities for data centers and Bitcoin mining and all the rest at that location?
Yeah, so great question. And I'm probably going to give you an answer that you're not going to like, but so I don't know is the short answer. So the entirety of the Lake Mariner property, which is 1,800 acres, sorry, that is owned by Beowulf, which is, or actually I should say, it's owned by Somerset Operating Company, which is 100% owned and controlled by Paul Prager. So TeraWulf leases, right, acreage from Somerset Operating Company or from Paul. And so that was done, by the way, for a specific reason. That was, it's a reclamated coal plant, and we didn't want TeraWulf at the time to have any of those liabilities, right, of being at a former coal plant site. So that was done on purpose. And many investors have brought to my attention, right, that entering into high power compute and AI is going to require more land and more megawatts. I know that, we are having discussions with Paul, which, as you can imagine, are board level, private subcommittee of the board, third-party advisors retained, fairness opinions, all kinds of stuff, right? So that'll all be done very properly, and our lease will be extended, and we will likely have more land. But so, Bryce, that's a long-winded way of saying, like, all that's going to become very clear. But with regards to what Paul does on the rest of the site, it's not my business. I don't know. I think, I've heard a little bit about the port. I think it could actually be very helpful to some of the economics at the site. But it's not something I'm focused on, and you should ask him about it.
Will do. Great. Thank you.
We've just seen an update from one of your competitors, Marathon Digital, where they've announced they're going to issue 250 million of notes to the market to buy Bitcoin. And it looks like they're following the MicroStrategy playbook here. I mean, what's your personal thoughts on this? I know TeraWulf obviously they don't hodl Bitcoin at the moment. It's quite a polarized view in the sort of like the community. So it'd be interesting just to get your take on that particular update this week.
Yeah, so I'll answer that, but I'm going to heavily caveat it with I'm taking off my TeraWulf hat and putting on my Patrick Fleury private investor hat. I mean, look, I think it's a joke, candidly. And what I mean by that is what MicroStrategy does in their business model makes 100% sense to me. They can borrow at virtually zero cost and go buy Bitcoin, right? So I can borrow at zero in fiat, which is a depreciating asset based on what the Fed and inflation is doing. And I can go buy Bitcoin and put it on my balance sheet. And it's just a capital arbitrage. That makes a lot of sense. Marathon, right, has a money-losing mining business. And look, I'm not, as my mother said, if you don't have anything nice to say, don't say anything at all. So take this with a grain of salt. But like, they don't have any other option, in my opinion, other than to pivot to some other strategy. So now they're out raising money to buy Bitcoin, but they're massively diluting shareholders on a daily, monthly, weekly basis in a money-losing Bitcoin and mining business. It just, like, that business model doesn't make sense to me. And again, I'm saying this as an 18-year buy-side investor in energy, power, and commodities. Like, if you want that model, just go buy the ETF for virtually 5 basis points, right? And you get the same exposure, and you can do that through your Charles Schwab account. But I just don't understand why you would buy a mining business that's losing money to make a bet on Bitcoin. And again, I don't mean any disrespect to them. I get that. I mean, that's maybe what they feel like they have to do to like stay alive, but that's not a business that I would personally invest in.
It's not too long ago that they actually converted some of the notes back into shares at a sort of a ridiculous exchange in terms of value of the company at the time, and the market capitalization was significantly smaller than it is now. So they gave away a lot of the company for a small amount of the notes they had previously. So, you know, that wasn't seen in a good light. And this just seems to be now another one of these off the wall, strategies that,
Yeah, look,
Anthony,
I would say as an investor, right? Again, in energy, power, commodity, public companies for a long, long time. My experience was if I asked a CEO or a CFO as an investor what their marginal cost of production is, and they didn't answer, it means one of two things. They're either stupid and don't know, which in case I don't want to be an investor in that company, or they're not telling you because they don't want you to know, in which case I don't want to be an investor in the company. So I think when I look at this space, unfortunately, and again, we probably do this to a fault, we are really transparent. Any cost question you have, I will answer it every single time, because that's my job, to provide that level of detail to investors so that they can make a decision on what company they want to own. The fact that a bunch of our biggest, quote, industry leading peers purposely don't answer questions on conference calls or other when asked by research analysts, I mean, to me, that immediately makes you a uninvestable company, period.
Yeah, I mean, we even remember you bringing out the actual cost to mine a Bitcoin model, which you put onto the website, and so you're even showing people saying, "Look, put your cost in here, and you'll determine the cost to mine a Bitcoin." So that was a sort of like nobody else had done that. So we did, and actually, Patrick, I've been in a number of spaces meeting with you, and you're very transparent. In fact, to the stage where sometimes it comes across as you're too transparent, if that can be an actual case. But
yeah, look, and believe me, Paul reminds me of that fault all the time. So don't worry, that's not lost on me.
I sort of like in this space at the moment, with mining companies, that there's sort of like what you provides shareholders and institutional investors with, an expectation that this is the norm, and it's not the norm. Believe you me, because once prices change, and if you go through a bear cycle, I'll be interested to see how many of these CEOs jump on, Spaces or other types of platforms to tell how good things are at the moment. But we appreciate everything that you've done.
To be honest, too, like the crazy thing is, it is the simplest business. It is power, SG&A, and site. There's only in site level expense, literally 3 expenses.
Yeah.
So again, like why you can't show people or can't answer the question, it's just kind of mind blowing to me. It makes no sense.
Hey, Patrick, we appreciate the explanation there. Now, a couple more quick questions for you. I know TeraWulf has a plan to reach 13.3 exahash this year in 2024. Can you just give us a couple quick comments in terms of growth strategy next year and how you guys are looking to allocate these megawatts?
Yeah, look, I think we've got a great Bitcoin mining business, and right, we're at 10.2 exahash. We've committed for the time being to building 5, which is 54 megawatts, being a Bitcoin mining business. But as you know, we're growing and diversifying into high power compute and AI. And so I think the vast majority of our megawatts going forward at Lake Mariner will be dedicated to high power compute and AI. You know, the one question, and by the way, that's for multiple reasons, as you know. I mean, the customer contracts are 5 to 20 years, right? The multiple for that, like the revenue stream is very solid. It's not a commodity business, so it achieves a much higher multiple. So again, this is all done because we, the management team, insiders, the board, as shareholders, our interests are fully aligned with our shareholders, which is we want to create the most value possible. And so we see that value arbitrage, right, between a Bitcoin miner, which is more like a refinery, right, which kind of tend to trade at like 6 to 12 times peak to trough through cycles, versus, you know, you look at the public data center companies and they trade at 20 to 25 times EBITDA. And not only that, but you can financially engineer them into REITs or other things, right, to really like achieve maximum multiple. So that's where we're going, because that business gets a much higher multiple. It's a better sort of credit quality business kind of going forward. And so that doesn't mean, by the way, you know, that, again, just to be really clear, like we love Bitcoin mining and we have a kick-ass Bitcoin mining business that is throwing off a lot of profit. And so the beauty of what we're doing, Bryce and Anthony, is, you know, I look at Lake Mariner. I mean, we have 500 megawatts of expansion into greenfield high power compute and AI before I have to go and touch anything related to my existing Bitcoin mining business. So the beauty of that is, if I can get the financial engineering done correctly on the high power compute and AI business, similar to what, you know, Core Scientific and CoreWeave have done, you know, and I tip my hat to Adam and the whole Core Scientific team. They've done an amazing job. And I couldn't be happier and prouder. I'm one of their biggest cheerleaders. I own that stock personally in my PA. So I am cheering them on. I think it's a $20 stock. But point being, if we can achieve that, I now need zero equity to grow into basically like 500 megawatts of high power compute and AI. And while I'm doing that, I've got a free cash flow positive Bitcoin mining business that, as you guys know, has a lot of operating leverage because my costs are largely fixed. So that's sort of the Shangri-La I'm trying to drive our business to. And I don't think we're that far away from it. But back to your point, Bryce, like I think maximum sort of megawatts, you know, sort of entering next year, building 5 is a Bitcoin mining building, 54 megawatts, that takes us to like 13.3 exahash, right? And I think at that point, that's kind of where we are. It's a pretty good economies of scale. And then, you know, we do have the option at Nautilus, which is very dynamic right now. And I think that's all going to get sorted out. But that's kind of where we're going from a Bitcoin mining perspective. And then, you know, I think over the next sort of, you know, 4 to 6 months, like a lot of the focus from our team is on growing into high power compute and AI.
So it sounds like, I mean, you've already answered one of the questions I was going to ask anyway, because I'm in my own mind, looking at your presentation, it looks like you're going to follow the playbook that Adam and the team at Core Scientific have done there with regards to their contract with CoreWeave, because a lot of other miners have done something totally different from that. They're the only ones that have gone out there and effectively going to be a high performance computing host company, and it looks like you're going to try and follow that playbook. How's that different from what you're doing at the moment? So you've got your model at the moment for the 2 megawatts or 2.5 megawatts, and also you're looking to expand another 20 megawatts in Q4. Is that that sounds like it's different to what could be happening next year? Is that something that you've already got sort of like customers for, or potential clients, etc.? Can you give a little bit of color to that to what you're doing this year?
Yeah, sure. So the short answer is no. And so the 2, the 20, and then 50, that's kind of timeline September, year end, and kind of March, April, right? Those are the timelines for the 2, 20, 50. And then we've got, around another 150 megawatts kind of coming before 25 year end. So the 2, the 20, and the 50, that timing is pretty set. The other expansion is really customer dependent. And so what I mean by that is all of our time right now is being spent on cultivating the right customer or customers. And what I mean by that is, I know institutional investors and retail investors are upset. They're like, I want an announcement yesterday. And I get that. I sat in that seat for 18 years. But I can put points up on the board if I wanted to do that. But that's not the best outcome for TeraWulf for 2, 5, and 10 years down the road. And what I mean by that is the customers that want 2 or 20 or 50, some of them are smaller, some are big. Some folks we're talking to want all of our megawatts, all of them. And so what I'm focused on, though, is we are energy power infrastructure people, right? We've been converting electrons to Bitcoin because that was the highest and best use. The highest and best use now, right, for us is high power compute and AI. But our aspirations are not just at Lake Mariner, they are global. And so if I can find a partner, right, that wants to utilize my infrastructure expertise globally, that's how I take TeraWulf forward. And when you look at our management team, other than Paul, right, who's the white-haired and I'm bald, but we're all in our early 40s. And so if I can make this company not just Lake Mariner, but Lake Mariner is kind of our model house, so to speak, and we're a developer, right? And so really what I'm doing with the 2 megawatts there is I've spent thousands of man hours with NVIDIA, Supermicro, HP, Dell. And so what we're doing is now saying, okay, we are committed. I'm going to build this sort of model home for you because I'm building a huge community of homes so that our customers and all of those OEMs can come and see and say, these guys have the design right. TeraWulf knows how to operate, right? And it's like proof of concept. And so that's kind of what we're then going to duplicate, although we are not, just to be really clear, we are not getting into GPU as a service. That is not our business. It is co-location, co-location, co-location. But I want to know, which is why we're buying a very small GPU cluster, is I want to know exactly how every single piece of that business works so that when I do have really big customers and we're like, I know exactly how the entire business works, right? And so that's, again, what we're doing. And I know people kind of want us to like run before we walk, but we're taking like a very measured approach to it. And I think the right approach, we have a kick-ass team that, I've been on calls with some of the biggest data center companies in the world, and they are super impressed by, the team that we are fielding. And as a CFO, to be honest, like I've been doing financial engineering for 25 years. I can do that. Like, I'm not worried about that. I am worried about execution on the ground as we get into this new business. And so to hear from big customers that we're talking to that, we are fielding an A++ team, that's critically important to me and gives me a lot of confidence.
Yeah, most definitely. I love the analogies, Patrick, and obviously learning a ton from this discussion as you talk about that vision of the management team and that long-term focus, which is really refreshing in this space. Anthony and I talk about that a lot, and to hear these 2, 5, 10-year kind of strategic plans coming into fruition is really exciting. So Anthony, I'll throw it back to you if you have any closing thoughts. Patrick, appreciate the insight today. You're always welcome back to the channel. It's been a great discussion. We appreciate your time. Understand you're very busy. You guys, if you're still watching, hit the like button, subscribe to the channel. Feel free to leave any comments or questions below. Anthony, I'll give you a final word, and then Patrick, you can wrap us up here.
Yeah, no, I just want to say thanks, Patrick, for your candor today and your transparency and getting through all the questions. We had more questions. I think, we could have done 2 hours on this conversation quite easily and got into more detail, but really appreciate you providing your time today. A busy time for the company. Earnings only came out yesterday, and I'm sure you've got a stack of meetings already planned in for the rest of the week to go. So appreciate you give us an early opportunity to sort of like showcase what your earnings results and what your growth looks like now over the next sort of 12, 18 months time. So looking forward to seeing some of those come into fruition, and we'll look forward to seeing yourself, Paul and Nazar and the rest of the team on the channel in the near future. Thanks.
Yeah, likewise. Thank you guys for having me. I'm glad we're not going 2 hours, because I'd probably dig myself even deeper into my honesty hole. But thank you guys for having me. Appreciate everything you're doing. And yeah, been
All the
great.
best. Congrats, and talk soon.